Last weekend was the first test of Australia's property market after the RBA's rate hike, and the auction data came back with a bit of a twist. Clearance rates dropped, but the market is still clearly in favour of sellers. At the same time, the Northern Territory quietly extended one of the most generous first home grants in the country. Today's update is about that tension between high rates and still pumped demand. So this isn't based on vibes from a couple of agents. The national auction numbers are from the weekly property update report for the week ending 7th of February, which pulls in results from all the major capitals. The supply and approval story comes from the ABS December building approvals release and fresh analysis from AMP's weekly economic notes last Thursday, which looked specifically at how far behind we are on the federal housing accord target. And the new first home policy signals is from the Northern Territory's government homegrown grant extension, reported this week by Real Estate Business and the Housing Industry Association. Most headlines will give you pieces of this. What they tend not to do is to put it together from an investor's point of view. And that's what we'll do now. Because when you actually step back, there are three big moves just in the last 7 days. Auctions stayed in sellers' market territory even after the first RBA hike in more than 2 years. Fresh analysis shows building approvals are running well below what's needed to hit the national supply target, and the Northern Territory has decided the answer is even more first home buyer stimulus. By the end of this video, you'll see how these three threads converge into one clear aha moment for 2026. Why prices can slow from here without necessarily falling, and what that means for where and when to buy. So let's start with the first full auction week after the RBA hike. According to Property Update's national auction wrap-up for the week ending 7th February, the combined capital city clearance rate came in at 71%. Now, that's down from 75.3% the previous week, but it's still well above the 63.3% recorded in the same week a year ago. In other words, the market's cooled a notch, but it's still very much a seller's market. Melbourne clocked a clearance rate of 69.6%, just down from 75% the prior week, and roughly in line with the same week last year. Sydney's numbers soften as well. The report shows a clearance rate in the mid-60s, a little lower than previous week, but still above where it was this time in 2025. Volumes are also ramping up as we move out of the January lull. Property Update notes early season auction markets remained clearly in favour of sellers in most capitals, although clearance rates were generally lower compared to the previous week's results. That's exactly what you'd expect when a new rate hike lands. Some marginal buyers get spooked or priced out, but the underlying demand supply balance hasn't flipped. For investors, the key takeaway is the first post-hike test did not produce a sudden buyer strike. It produced a slight step down in momentum. So next is supply. We already knew last week that December building approvals fell around 15% month on month, mostly because apartment approvals reversed November's spike. What changed this week is how economists are framing that in relation to the federal housing accord target. AMP's weekly economic update, released on 5th of February, points out that while December was a sharp monthly fall, the trend in approvals is still running at roughly 200,000 dwellings a year. That's an improvement on 2024, but it's well below the housing accord's 240,000 dwelling per year aspiration. And more importantly, AMP highlights that the RBA's own forecasts for dwelling investments, published alongside last week's rate decision, show residential construction is slowing and then going negative around 2028. In plain language, the central bank does not believe the housing accord target will be met on current settings because it will require dwelling investment to start accelerating instead of decelerating. So even before you add this week's rate hike into the mix, the official data plus the RBA's forecasts are effectively saying we're under building relative to the political target, and the policymakers that actually set monetary policy don't have a plausible path yet to reach the 1.2 million homes number. And that's crucial context for any investor thinking about long-term supply and vacancy. Now, while the national supply story is struggling, the Northern Territory this week decided to push demand even harder at the entry level. On 3rd of February, Real Estate Business reported that the Northern Territory government has extended its homegrown build grants program to September 2027. This program provides $30,000 to $50,000 for eligible buyers to build or buy a new home in the territory. So here are some key numbers. More than 400 homegrown build grants have already been approved. That's over $12 million in direct grants funding. HIA estimates this has driven around $180 million in local construction activity so far. Since May 2025, the Northern Territory government says about 25 homegrown grants per week have been issued. And the official language from the Chief Minister is telling. The extension is explicitly about giving builders and families the confidence to commit to new projects and smoothing out the construction pipeline through 2027. From an investor's perspective, the Northern Territory is a small part of the national market, but it's a signpost of policy thinking. On one hand, we have national data and the RBA signaling that dwelling investment will likely slow. On the other, a territory government is making it even cheaper for first home buyers to build, using grants instead of structural supply reform. The lesson isn't go and buy Darwin tomorrow. It's that policy continues to skew more towards stimulating ownership demand than fixing deep supply issues. So to complete the picture here, it's worth looking at how the mood on the ground shifted this week. Square Real Estate's weekly update for 6th of February pulled together a few strands from Domain and Smart Property Investment. First home buyer mortgage lodgements surged after the expansion of the federal 5% deposit scheme. And although they've eased slightly from intake spikes, demand remains elevated compared to pre-expansion levels. Queensland actually led the growth, followed by New South Wales, and Victoria still has the highest absolute volume of first home buyers. National listings rose modestly in January as sellers came back from the holidays, but stock levels are still significantly lower than a year ago, reinforcing that tight supply. Asking prices showed continued strength in Brisbane, Perth, and Adelaide, while Sydney and Melbourne were steadier. Units outperformed houses nationally, reflecting affordability pressures as buyers look for cheaper entry points, and distressed listings remain historically low, suggesting financial stress is still contained despite high interest rates. That's consistent with what we're seeing in the auction data, a market that is cooling from a very strong starting point, not flipping into distress. For risk, the message is subtle. Households are being squeezed, but we're not yet seeing a wave of forced selling. Instead, we're seeing buyers adjust what they buy. More units, more fringe or smaller markets rather than walk away altogether. Put all this together and you get this week's aha moment. In the last 7 days, we've had the first auction read-through after the RBA hike. The clearance rates are down a little, but still over the 70% nationally and near 70% in Melbourne. That's still a seller's market territory. And fresh macro analysis is showing building approvals trending at about 200,000 dwellings a year, when the target is 240,000. And the RBA itself is expecting dwelling investment to actually go backwards towards the end of the decade. A territory government is extending large grants, $30,000 to $50,000 to first home buyers out to September 2027, with 400 plus grants already in play and $180 million in construction actively generated. The contradiction is obvious. The RBA is raising rates to cool inflation and, by extension, cool housing. The construction pipeline is already too weak to hit national supply goals. And the governments are still leaning on demand-side incentives, grants, guarantees, low deposit schemes to keep housing access politically palatable. So for investors, that combination has 3 key implications here. Price growth is more likely to slow than to reverse. With clearance rates easing and borrowing power hit by high rates, you shouldn't expect the 2025 style price gains to repeat, but structurally low listings and underbuilding make a deep nationwide correction less likely without a much larger economic shock. 2, the entry level remains the most distorted. First home buyer grants, low deposit guarantees, and now the Northern Territory's homegrown extension all disproportionately target the cheaper end. That can push up prices and competition for the very stock many investors also want, the sub 700K price range for houses and townhouses in decent, commutable locations. Yield and cash flow matter more than ever. With another 0.25% cash rate already passed through to mortgage rates, the economists openly discussing the chance of a second hike later in 2026. Your buffer on each property and your portfolio level cash flow is the difference between staying opportunistic and being forced to sell. The big picture, the system is still set up to protect nominal housing prices, even as affordability gets worse. That's good if you already own, but it raises the bar for how careful you need to be on new purchases. So let's quickly anchor what didn't move this week, because that's just as important as cutting through the noise. So rental, vacancy, and rent data. There was no new major national vacancy released this week. The latest SQM research figures still have the national combined vacancy at around 1.4% and combined rents up around 5.8% year on year as of December. We'll actually get a fresh January dated rental data in the next fortnight, but there's no sign of structural easing just yet. Migration of population data, we don't have any new ABS population or net overseas migration releases landed this week. So the underlying story is still strong population growth is underpinning demand in Perth, Brisbane, Adelaide, and parts of regional Queensland, WA, and SA. It's still completely unchanged. Core national price levels, daily home value indices are still digesting the rate move, but there was no new monthly home value index released this week. The most recent figures show national dwelling values still nudging higher into January, with growth slowing but not stopping. And RBA guidance. Beyond the statement that accompanied last week's decision, there were no new RBA speeches or forecasts this week. The bank's position, one hike delivered, future moves, meeting by meeting based on inflation, hasn't actually shifted. So why does this matter? It tells you that the structural backdrop, the tight rentals, undersupply, the strong population is still in place. This week's changes are adjustments around the edge, auctions easing a bit off boom time levels, more clarity from economists on the supply gap, and yet another signal that governments are more comfortable boosting demand than tackling planning and construction constraints. So looking ahead to the next 7 days, here's what's actually worth watching. Post-hike auction trends. The next 2 auction weekends will tell us whether that national clearance rate holds around 70% or drifts to the lower 60s. That's the practical test of how much the rate rise has actually been. Any new ABS releases on lending or even wages. New housing finance data will show how quickly banks and borrowers are adjusting to higher rates and first home buyer incentives. Wage figures will matter for how sustainable current prices levels are. And fresh rental data. SQM's weekly rent and vacancy numbers for late January and early Feb will give the first sign of whether rental inflation is accelerating into 2026 or stabilizing. Next week's update will dig into those numbers and, importantly, whether we're seeing meaningful change or buyer stress. If this kind of weekly breakdown helps you make sense of the noise, especially when everybody is screaming different things about rate hikes, grants, crashes, do me a favor, hit like, drop a comment in what you're seeing in your local market, and subscribe so you don't miss the next update. And if you're looking at all of this and thinking, I get the big picture, I still don't know where I should buy next, or whether a new purchase even stacks up at these rates, that's exactly what Investor was built for. Inside Investor, you'll find tools to model your cash flow under different rate scenarios, compare suburbs based on real data, prices, yields, infrastructure, and risk. And if you want the heads up help and the hands-on help, work with a buyer's agent who actually lives and breathes the stuff. There's a link in the description. If you'd like a second set of eyes on your position and your next move, book a free strategy call and we'll walk you through it calmly with numbers and not the hype. Thank you for watching.